What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So we have a lot to cover in this update. We're going to be going over the current Ortex numbers that we are seeing at the current time that I'm recording. We are going to go over the potential gamma squeeze that we have coming up for AMC. If we continue to see these bullish price movements to the upside, we have AMC shattering revenue records. We have the SEC starting to crack down. And in addition to this, we also have Goldman Sachs issuing a massive downgrade. This is actually the third time that they have done this over the last couple of months, and it just shows us that the overall market in the economy of the United States is not in a good spot, and there's really no solution at the current time, which you guys are going to see a little bit later when we conclude this video. And all of this ties back to AMC, and when we look at the broad market, it has a lot of implications on this short squeeze situation that we have going on for AMC at the current time. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And the more people that we have staying up to date on accurate AMC information, the stronger our community becomes. And if you want to see more videos like this, make sure you hit that subscribe button. So at the current time that I'm recording, AMC is currently trading at $46.30. We've seen a little bit of volatility today. And again, I do have classes that I have to go to later today. So I do have to get these videos recorded a little bit later than I usually would have before classes started. So when we come over and take a look at this Ortex update, again, we were talking about utilization and how it was most likely going to increase going into this week. And we are seeing that increase right here. We are currently sitting at about 91.43%. In order to see the pressure from these institutions for these forced share recalls and a massive increase in these cost to borrows, we're going to need to see the utilization get a lot higher than what it is now. We have seen it get to that 99 to 100% range in the past, and I do think that it is entirely possible that with all of the shares going out on loan every single day, we could end up getting to that 99 to 100% utilization. And again, utilization is just the amount of shares that institutions are willing to lend out versus the amount of shares that have been lent out already. Now, also, short interest, still incredibly high, 18.59%. We are still steadily climbing on the short interest. And what this shows us is that not only are shorts not covering their positions in a widespread scale, but they are also adding to their position. Now, when we come over to Stonko Tracker right here, to get a decent understanding of how many calls are in the money going into this week. Right now, it is the first trading day of the week, even though it is Tuesday. We only have 43,950 calls in the money. But what you have to remember is that this is a weekly options expiration date, so we aren't necessarily going to see the crazy high amount of volume or the crazy high amount of open interest. And especially for this week with one less trading day, where it's one less day for institutions to sell these contracts and buyers of these contracts to come in and scoop up these shares, we are most likely going to see somewhat of less open interest going into the end of this week. But again, we already have a very significant amount of contracts in the money already for this September 17th date. But the in the money contracts at the current time is not what I really want a lot of people to be focusing on, because when the contracts go in the money, most likely they're already being hedged for. The out of the money contracts are the ones that we really need to be looking for. We have seen a pretty significant amount of contracts in step ups of 10. So let's take a look at the option chain right here for this September 17th date. When we come right here, 50, pretty big level in terms of open interest. 60, again, then we have 65 and 70. So again, you can see this little step up ramp here, where if we start to have a big move up, we are going to see more buying volume pushed into the stock due to these institutions having to hedge these contracts. Now, when we come over to this page right here, this is very important information. AMC Theaters sets a new Labor Day weekend admissions revenue record Thursday through Sunday on the strength of the record-shattering Shang-Chi and the Legend of the Ten Rings. Now, what we have to think about here is that this is not only a pandemic record for Labor Day, but it is an overall record for all Labor Days. The fact that AMC is breaking these types of records even when we are still not fully open as an economy, is incredibly bullish in my opinion. It just goes to show us that the retail investors who are putting their money into the stock that not only saw the fundamental value that this company could bring as the economy starts to reopen, but the short squeeze play as well. Now, let's move on to this SEC crackdown, potential SEC and government crackdown that we have been looking for over the past couple of months. But one thing that I want to say before we get into this is I know a lot of people have been saying that the SEC has not been doing anything. This is a very, very weird statement that I've been seeing come out a lot, and people are very basically upset that they don't think the SEC is doing what they need to do. One, I don't necessarily believe that the SEC is going to be the catalyst to start the squeeze. The SEC is most likely going to come in after this event happens to make sure it never happens again. And the second thing is that we have seen notices from the SEC that they do not disclose publicly what they are investigating. That would be a very silly thing for them to do. It's like going to a law firm and basically asking, hey, can I receive all of the information about what you are researching right now, or according to this case, or going to a really famous hedge fund and being like, hey, can I see your algorithm? They would never let you do that. So I hope that everybody really understands that the SEC, one, they're not going to tell you, and two, it's most likely going to be an investigation that comes out many, many years later, and it is not going to be the catalyst that starts the squeeze. But a thing that can make our markets more fair is this conversation surrounding payment for order flow. So U.S. Securities and Exchange Commission Chair Gary Gensler will lean on corporate disclosures as the Biden administration sets its eyes on curbing anti-competitive behavior. In a meeting of the newly formed White House Competition Council set to take place later this week, Gensler will also emphasize the agency's examination of the impact of revenue models like payment for order flows. We have basically seen the government give the SEC the ability to research payment for order flow and its impact, and we are going to see most likely the results of some of their research. But again, this is most likely going to take a lot of time to play out, but what we see here is a really, really good step in the right direction. Now, what I want to cover next is a conversation that we've been talking about surrounding the overall economy and our financial markets. When we come over to this article right here, Goldman cuts its U.S. GDP forecast for the third time in the past month. That is not good. When we look over here, in the case of Morgan Stanley, a nuke to their GDP Q3 forecast, with the bank on Thursday cutting its Q3 GDP to just 2.9% from 6.5% previously. That is a very big drop. Now, let's take a look at what Goldman has done. On August 16th, Goldman cuts its laughable Q3 GDP forecast from 8.5% to 5.5%. Then on Thursday, September 2nd, they cut it again, and they essentially moved it from that 5.5 all the way down to 3.5. Then 4 days later, September 6th, under the cover of the Memorial Day holiday, Goldman just cut its Q3 GDP forecast for the third time. And while the bank kept its Q3 GDP forecast at 3.5%, it is now starting to cut its outer forecast, starting with Q4 GDP, which it now sees at 5.5%, down from 6.5%. So here's what we need to look at here. GDP is going to give us an idea of what we are going to see for economic growth. GDP is the gross domestic product. It is essentially what we are able to produce as a country. If we are seeing all of these big institutions basically saying that we are not going to be growing at the rates that we previously thought, that is not only showing signs of less economic growth, but also economic slowdown. So here's what we need to think about here. We did see the jobs report come out massively lower last week. So here's kind of what we're seeing. In order for the Fed to taper the asset purchases, they need to have really good signs of economic growth. Now, if they do taper, they are going to basically cause a slight decrease in the overall market. That is most likely going to happen. But if we see economic growth not happen, the market will most likely continue to go up, but it is just delaying the problem. When we are not seeing economic growth and the markets are continuously going up, it just furthers the problem that we have been seeing. And in addition to this, we also have a problem with real estate. Goldman sees 750,000 evictions in U.S. as bans come to an end. Things are not looking great right now for our overall financial markets, and we also have a lot of other catalysts as well. We have the debt ceiling, we have the new CPI numbers coming out soon, which is going to reflect inflation, and inflation has been coming out a lot higher than expected. So what we need to look at here is that the market and our economy are essentially teetering on the brink of some major event happening. It's really going to come down to what the Fed is going to be able to do in order to prevent an event happening. If the Fed is able to continue to kick the can down the road, we are most likely going to see the markets continue to go up. But on the off chance that the Fed is no longer able to do anything about this situation that we have going on with our economy and the market right now, the fact that they have artificially propped up everything that has been going on over the last year or so is just going to make this correction that could be coming even worse. So that is going to wrap up this update on AMC in the broad market. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.